Welcome to Financial Analysis in Review, your quick guide to today's top financial videos. Is your financial future at risk? We'll break down the latest warnings about a recession and what market signals mean for your investments.
Expert predictions on a stock market crash will have you on the edge of your seat, and we'll uncover what's next for the Fed's policies.
Like and subscribe to support the channel. Now, what insights do we have lined up?
Today, we're going to provide summaries of 8 insightful videos covering stocks, the Fed, housing, and more.
First, Brian Kim dissects J.P. Powell's take on America's biggest economic challenge on ClearValue tax. Next, Jason Shapiro shares why the Nasdaq had its worst day since 2022 on David Lin's channel. Then, Michael Green asserts the stock market's unsustainable bubble on thoughtful money with Adam Taggart. Jeff Snyder unpacks the hidden critical role of swap spreads in the global economy on Eurodollar University. Matt from Trade Brigade reveals unsettling trends in the Nasdaq 100 that could spell trouble. Steve Hanke predicts falling inflation and a looming recession on the Julia LaRoche show. Danielle DiMartino Booth critiques Powell's Fed and foresees possible drastic rate cuts. Finally, Andy Constan explains why a soft economic landing might be a fantasy on Blockworks Macro. Welcome to ClearValue Tax. We've got Brian Kim today to dive into J.P. Powell's insights on America's biggest economic challenge. Buckle up for some serious economic analysis.
Absolutely. Brian does a fantastic job breaking down Powell's key points from his July 15th address, particularly his concerns about balancing inflation and economic stability. Let's get into it.
All right, so what's the main takeaway from Powell's latest statements?
The main thesis is all about balance. Powell is wrestling with the delicate act of fighting inflation without putting the brakes on economic growth too hard. High stakes and high tension.
Got it. So what are the short-term economic challenges Powell highlighted?
Powell is laser-focused on not cutting rates too soon to avoid rekindling inflation, but also not waiting too long, which could slow down the economy and job growth. It's a high-wire act.
And how do interest rates play into this balancing act?
High interest rates curb demand in crucial markets like housing. If mortgage rates drop from 7% to 3%, demand will skyrocket, driving prices and inflation up again. Same story for business loans. Lower rates mean more spending, more demand, and more inflation.
What about the Fed's dual mandate? How does that fit in?
Great question. The Fed's dual mandate includes managing inflation and ensuring maximum employment. Current market odds for a rate cut are low for July but nearly 98% for September, showing cautious optimism that they can balance both objectives soon.
Now, what's Powell saying about long-term concerns?
Powell is worried about the unsustainable fiscal path due to the enormous national debt, about $35 trillion. He's hopeful Congress will take bipartisan action to address this long-term threat.
All right, let's speculate. What are the predictions based on Powell's insights?
First, expect a high chance of rate cuts by September, indicating the Fed's confidence that inflation is on a downward trend. Second, Powell predicts the need for serious fiscal reforms to manage national debt sustainably.
To wrap it all up, what are the key takeaways?
The Fed's juggling act of combating inflation without halting growth continues. Powell suggests imminent rate cuts but emphasizes the need for long-term fiscal sustainability. Cautious optimism with a call for strategic fiscal policy, sound advice for navigating the economic waters ahead.
Welcome to the David Lin Show on YouTube. Today, we're recapping a fascinating conversation with none other than Jason Shapiro, the notable trader and owner of CrowdedMarketReport.com.
Absolutely, Jason's insightful takes on market dynamics make this a must-watch. He's been featured in one of Jack Schwager's Market Wizards books and always brings a unique perspective. Let's dive in.
All right, so what's the main takeaway from Jason's latest market insights?
The core thesis revolves around understanding market movements through positioning and sentiment analysis. Jason notes a shift in tech stocks and small caps, emphasizing the importance of upcoming events like rate cuts and a potential Trump victory.
Let's break down the key points. What was Jason's take on recent market inflection points?
Jason revisited his previous inflection point call and noted it was mostly accurate. He highlights a recent trend where tech stocks have stalled while small caps have surged.
Interesting. And what did he say about the wall of worry in the market?
With concerns like rate cuts and election outcomes becoming more predictable, the wall of worry has lowered. This, in Jason's view, reduces the potential for further market upside.
Got it. Now, what about the Russell and its positioning?
Recently, the Russell had been heavily shorted. As these positions unwound, the index saw a remarkable rally, showcasing how sentiment shifts can drive significant market moves.
So sentiment really plays a crucial role. How are tech stocks faring in his analysis?
Tech stocks, especially the Nasdaq, are underperforming recently. Jason sees this as a negative signal, suggesting caution for bull market enthusiasts.
All right, we're entering crystal ball territory. What predictions did Jason make?
Jason expects pre-rate cut sell-offs as investors might front-run the trade, but he also believes the market could rally post-rate cut. Additionally, he sees a potential opportunity to short if Trump wins and the market rallies leading into the election.
So, what's the ultimate takeaway from Jason's discussion?
Jason underscores the importance of market sentiment and positioning. He suggests a careful approach as the market navigates future rate cuts and political changes, emphasizing that patience might be the best strategy for now.
Welcome to another episode on the Adam Taggart Thoughtful Money channel. We have a riveting topic today. Michael Green, the stock market is now a giant Ponzi scheme. In this episode, Adam chats with the insightful Michael Green, portfolio manager and chief strategist at Simplify Asset Management. Buckle up, because this conversation dives into the potential pitfalls of the stock market as we know it.
That's right. Michael Green brings some heavy-hitting insights into how passive investing might be inflating asset bubbles in a Ponzi-like fashion. His extensive experience in asset management provides a unique vantage point, making this a must-watch.
So, what's the core argument Michael is making in this eye-opening episode?
In short, he claims that the stock market has transformed into a giant Ponzi scheme, predominantly driven by passive investment inflows. He warns that this creates phantom value and isn't sustainable in the long run.
Interesting. Let's break down some key points. What's this giant mindless robot all about?
Great question. Michael describes passive investments as a giant mindless robot, capital that keeps pouring into the market every month, propping up asset prices regardless of their true value. This mechanism disregards stock fundamentals entirely.
That sounds risky. How does this play out in the broader economic landscape?
Despite clear economic weaknesses like rising unemployment and a slowing housing market, the stock market keeps climbing. Why? Because the passive investment flows are relentless, creating a divergence between stock prices and economic reality.
All right, and how do employment trends fit into this narrative?
Unemployment is rising, even among college grads and less skilled sectors. Green argues that the gig economy and low unemployment compensation make traditional metrics unreliable, adding another layer of economic fragility.
So if passive funds start to withdraw, who steps in to pick up the slack?
That's the million-dollar, or should I say trillion-dollar, question. Green points out that companies issuing shares to meet passive demand won't necessarily buy them back. If passive inflows stop, the market could face a severe correction.
So, what predictions does Michael offer concerning this potential market scenario?
Michael predicts that this Ponzi scheme is unsustainable and will eventually burst, leading to a significant market correction. He also notes that demographic changes like the aging baby boomers could flip the passive investment model to outflows, exacerbating the situation.
Beyond market corrections, any policy changes on the horizon?
Green anticipates political and regulatory changes to manage or mitigate the impacts of passive investments, but he warns these may come too late to prevent substantial economic stress.
As we start wrapping up, what are the big takeaways from Michael's insights?
Michael's main message is to approach the market with strategic caution. He emphasizes that the current reliance on passive investing is unsustainable and stresses the importance of a balanced portfolio strategy to navigate these economic discrepancies. It's a wake-up call for all investors.
Welcome to Eurodollar University on YouTube. Today, we're diving into the deep end of the financial pool with a focus on swap spreads. What's that, you ask? Well, hang tight, because Jeff Snyder is explaining why these little-known financial instruments are making waves in the global monetary system.
Oh, Swap spreads? Sounds like financial jargon, but trust me, folks, this could make or break the global economy. Jeff's on point as usual.
All right, give us the scoop. What's the main takeaway from Jeff Snyder's video on swap spreads?
The core thesis is that swap spreads are critically important for gauging the health of the global financial system. Jeff explains that movements in these spreads offer key signals about current and future economic conditions, hinting at potential recessions.
Sounds significant. Let's break down some key points from Jeff's discussion, starting with the basics. What exactly are interest rate swaps?
Interest rate swaps are where one party pays a fixed rate and receives a floating rate, while the other side does the reverse. Think of it like a financial handshake over different interest payments. We used to calculate these floating rates based on LIBOR, but now it's all about SOFR.
Got it. Now, how about those swap spreads?
A swap spread essentially compares the fixed rate in the swap market to the yield on a similar maturity U.S. Treasury. The spread provides insights into monetary conditions, especially dealer balance sheet capacity and hedging demand.
Interesting. What's driving these spreads then?
On the supply side, it's all about the money dealers. Think big financial institutions with lots of treasury holdings. For demand, it's market players hedging against future economic uncertainties. If they think short-term rates will fall, they'll demand more fixed-rate swaps.
That makes sense. How have swap spreads been behaving lately?
Swap spreads are hitting record lows, signaling high demand for hedging against scenarios where short-term interest rates decline and stay low. Combine this with other economic indicators, and you've got a pretty strong case for rising recession fears.
All right, let's get the predictions straight from Jeff. What's on the horizon?
First up, increased compression in swap spreads points toward growing recession risks. More players are hedging, preparing for short-term rates to drop. Plus, these persistent low spreads also hint that global economic conditions might keep rates lower for longer. It's all interconnected.
To wrap it all up, what are the main takeaways from Jeff's analysis?
The sharp movement in swap spreads is a glaring warning about the global financial system. The high demand for hedging and tight dealer capacities indicate potential economic downturns. Keeping an eye on swap spreads can offer crucial insights into what's coming next, a true financial barometer.
Welcome to the Trade Brigade Midweek Market Update, your go-to for breaking down what the charts are screaming today. I'm looking at you, Nasdaq. Matt's got a tough love session lined up for us.
Indeed, Matt deep dives into the Nasdaq's significant weakness. It's not all doom and gloom for the S&P, but tech's stumble isn't something to ignore.
So what's Matt's big takeaway this time around?
Today's sell-off did more damage than last week's. The Nasdaq failed to hold key levels, putting tech stocks in the hot seat, while the S&P, albeit resilient, could face pressure.
Got it. Let's break it down further, starting with the SPY daily time frame. Any bright spots there?
Well, the SPY is still in an uptrend. Despite today's pullback, it recently hit a new all-time high, so it can afford to see some higher lows.
And what about our tech-heavy friend, the Nasdaq?
The Nasdaq is struggling. It couldn't hold on to crucial support levels and shows more significant downside risk, especially with geopolitical jitters surrounding semiconductors.
Yikes. Okay, let's zoom in on the hourly trends. What's the scoop there?
Both the S&P and Nasdaq are shaping up for hourly downtrends. We tested key levels but saw no strong buying support. Tech is lagging, pulling the broader market down.
Internals were mentioned. Were they telling?
Absolutely. The volume outflows were substantial, and the advanced decline lines were in poor shape. This wasn't just a minor hiccup. The sell-off is more systemic compared to last week.
Future gazing time. What are Matt's calls for the upcoming sessions?
Matt sees a possible pullback continuing, particularly in tech. Traders should be on the lookout for lower high setups and short opportunities at resistance levels.
To wrap it up neatly, what's the big headline?
Cautious optimism. The S&P could hold its own with daily higher lows, but the Nasdaq's failure suggests staying alert for more selling. Keep those lower high setups in your toolkit.
Welcome to the Julia LaRoche Show on YouTube. Today's episode is a must-watch as we discuss economic vibes you can't ignore. Julia's guest is Steve Hanke, a heavyweight in the world of economics from Johns Hopkins University. Ready for a deep dive?
Absolutely. Hanke's here to demystify the ups and downs of inflation and the looming recession. He's got the street cred with his role at Johns Hopkins and his deep dive into economic theory. Buckle up, folks. It's going to be a ride.
So, cut to the chase. What's the big idea from Steve Hanke's interview?
In a nutshell, Hanke believes inflation in the U.S. is dropping like a hot potato, expecting it to hit between 2.5% and 3% by the end of this year. But hold on to your hats. He also says a recession is on the horizon, likely late this year or early next year.
All right, let's unpack those points. What's the framework Hanke uses to look at the economy?
Hanke's all about the quantity theory of money. This theory suggests that changes in the money supply drive economic activity and inflation. Remember the COVID-19 financial roller coaster? Money supply shot up, causing inflation, and then the Fed pumped the brakes to bring it back down.
Got it. So how's inflation looking these days?
After peaking at 9.1%, inflation is now chilling at around 3%. Hanke bets it will keep dropping, hitting that sweet spot between 2.5% to 3% by year-end. Quite the downward trend.
Interesting. And what's his take on the recession?
As inflation cools down, brace yourselves. Hanke predicts the economy will likely dip into a recession late this year or early next year. It's like the calm before the storm.
Spicy. How does he grade the Fed's performance?
Ouch! Hanke gives the Fed an F for their oversight on ignoring money supply metrics. He's pretty brutal, saying they missed the forest for the trees by not focusing on the root causes of economic shifts.
That's harsh. What does he say about the national debt?
With the U.S. debt ballooning to nearly $34.9 trillion, Hanke warns it's unsustainable. He suggests a constitutional amendment akin to Switzerland's debt brake to bring long-term fiscal discipline. Ambitious, right?
All right, let's gaze into Hanke's crystal ball. What predictions does he have?
First up, he foresees inflation dropping below the 2% target, dragging interest rates down, including mortgage rates. Second, brace yourself for a recession. It's coming sooner rather than later.
So, wrapping it all up, what's the takeaway?
Hanke calls for a sharper focus on the money supply to manage inflation and avoid economic pitfalls. He advocates for institutional changes to ensure sustainable fiscal policies. It looks like we're in for an economic shakeup, folks.
Welcome back to the Danielle DiMartino Booth channel on YouTube. Today, we've got a special summary from the RULE Symposium. Get ready to dive into some sizzling economic insights.
Absolutely. Danielle dives into the nitty-gritty of Fed policies, Jerome Powell's latest moves, and the economic storms brewing ahead. Buckle up.
So, what's the main takeaway from Danielle's chat at the RULE Symposium?
Danielle argues that Jerome Powell's Fed is playing catch-up, pushing interest rates higher than necessary. This delay could lead to substantial rate cuts later this year, reshaping the economic landscape.
All right, let's break down some key points Danielle highlighted. What's Powell up to?
Powell is juggling the risks of over-tightening and under-tightening the policy. Danielle thinks he knows he's behind the curve, but supports keeping rates high for now.
Interesting. And about those rate cuts predictions?
Initially, markets thought we'd see 6 to 7 rate cuts this year. That's been trimmed down. Danielle mentions a crucial data revision on July 24th that could influence Powell's next moves.
She also discussed some economic indicators. What's the scoop there?
She uses the Melly rule to suggest the recession actually started in October 2023. This aligns with new job loss data, signaling deeper economic issues.
And are Fed decisions swayed by politics?
Despite the chatter, Powell insists the Fed remains apolitical. Even with potential rate cuts before elections, it's all data-driven. Or so he says.
What impact is all this having on markets and jobs?
Danielle shines a light on flows, the real economic movers. The struggle is evident in job cuts, especially in Silicon Valley, where AI is replacing many roles. It's a new battlefront.
Time for some crystal ball gazing. What does Danielle see ahead?
She predicts deeper job cuts this earnings season, worsening the downturn. Commercial real estate and small banks are in the danger zone, needing creative solutions to stay afloat.
What's Danielle's closing advice?
She emphasizes strategic political actions to curb runaway spending and insists that the Fed accurately monitor cash flows to navigate forthcoming challenges. Sage advice for stormy seas.
Welcome to Blockworks Macro. Today, we're chatting about a thought-provoking episode featuring Andy Constan. Ready to debunk some myths about a soft economic landing?
Absolutely. Andy Constan from Damp Spring Advisors joins the show to explain why expecting a soft landing is like hoping for a unicorn. Fantastical, but probably not happening. Shall we get into it?
So what's Andy's main argument here? What's got us ditching our cozy soft landing fantasies?
Andy posits that a soft landing is entirely unrealistic. He argues the economy will stay above trend growth and desired inflation, which means the Fed will need to keep interest rates higher for longer to stable things out.
Interesting. Now, he uses this concept of economic islands. Can you break that down for us?
Certainly. Andy's economic islands include higher for longer, where Fed rates remain high, recession island, classic recession scenario, and Goldilocks, a stable land with target in growth. He thinks we're stuck between the first two, with Goldilocks being a pipe dream.
That's a good mix of reality checks and wishful thinking. What does Andy say about the Fed's strategy?
He highlights that the Fed's rate hikes don't pack the same punch as they used to, thanks to fixed-rate mortgages and bank funding dynamics. Instead of tightening financial conditions, market anticipation of cuts is stirring animal spirits and stimulating the economy.
Animal spirits, huh? Sounds like a zoo in there. Where do financial conditions fit into all this?
Andy stresses that financial conditions, not just short-term rates, are what really drive the economy. Strong asset performance, for instance, tends to stimulate economic activity, and tight financial conditions lead to immediate slowdowns.
Got it. And there's something brewing with the Treasury General Account too, right?
Right? The TGA acts as a buffer for disruptions. While some speculate on potential changes, Andy expects it to stay around $800 billion to safeguard against market hiccups.
All right, let's pull out the crystal ball. What predictions does Andy have in store for us?
He's forecasting positive surprise trends in future economic data, especially retail sales and CPI-PPI numbers. On rates, he believes significant cuts are unlikely, maintaining that higher rates will persist thanks to stronger than expected economic performance.
No cuts in the cards, huh? Tough break for anyone banking on that. And market behavior?
Expect a bear flattener, where short-term rates rise more than long-term ones. Bond yields will likely adjust accordingly. If you're into equities, they'd outperform bonds, but might not outshine cash.
So what's Andy's big takeaway?
He underscores the need for realism. Higher rates might be a headache for markets, but are crucial for the economy. And remember, passive investments, holding long-term assets, often outperform active market timing strategies. Diversification and smart long-term plays are key.
Solid advice. Well, that wraps things up. Until next time on Blockworks Macro, stay informed, stay strategic, and don't go chasing economic unicorns. In today's roundup, Brian Kim and Danielle DiMartino Booth discussed the Fed's challenge to balance inflation with economic growth, while Michael Green warned of a passive investing-driven market bubble.
Jason Shapiro pointed to risky market dynamics around upcoming rate cuts, and Jeff Snyder highlighted recession signals from swap spreads data.
Steve Hanke and Andy Constan agree on the likelihood of an economic downturn, with Hanke focusing on the importance of money supply and Constan emphasizing sustained higher rates.
Despite varied perspectives, the common theme is caution and strategic preparedness in navigating these financial waters. Until next time on Financial Analysis in Review, stay informed and stay ahead.
Thanks for watching Financial Analysis in Review for July 18th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.